Welcome to this week's Q&A. It's a pretty warm day here at the moment, so even though it's almost evening, we'll jump into some pretty interesting stuff. One of our viewers from Sydney actually asked this question, and he said, is APRA likely to intervene with its macro-prudential measures to try and cool Australian property prices? It's a great question, and it's really topical right now because we're seeing lots of news in relation to this. Various economists are divided in terms of, should they do something, shouldn't they do something? And there's a lot of talk about this. So it is a really good question. But it brings other things, I think, to the fore also. And one of those is obviously which markets, because certainly as our viewers will probably know by now, there are many markets in Australia. There are the 8 capital city markets, there are another 7 regional markets, and so forth and so on. So we've got to think this through and look at, what are these people actually referring to? So this person was actually living in Sydney, and he was asking the question in relation to the Sydney property market. But this is where the research comes in, because we've just actually had the latest data released by CoreLogic today. And if I had been presenting this yesterday, it would be slightly different to today. So it's actually opportune that we can get the latest data and look at what impacts that may actually have on all of this. Because, fundamentally, APRA is not here to try and control property prices. It's really looking to ensure financial stability and assist the RBA and the other regulators and Treasury to make sure they do a good job, as I think they have been. So if we have a look at this, the latest data that we've just seen in terms of house price movements is quite staggering. Sydney has recorded one of the largest jumps since 1988. And it's interesting because, again, yesterday I would have been talking about 4 of the capital city markets being below their all-time high. But at the moment, now we've got 6 of the 8 capital city markets above their prior highs on a nominal basis. So we still have Perth, which is down about 16%, and Darwin, which is down about 20% from their 2014 highs. But now Sydney and Melbourne have suddenly caught up, and they've had this massive increase over the month of March. Very interestingly, if you look at what's happened, the upper quartile in both Sydney and Melbourne, Sydney in particular, has really shot up 4.8% in the month of March, whereas a lower quartile has only risen 2.2%. And the difference is even greater in Brisbane, where the upper quartile rose 3.1% and the lower quartile 1.1%. So as we always tell our clients, quality is really important. Buy quality assets in sought-after locations, and that should give you better capital growth over time and protect your investment portfolio. So let's have a look at what else is happening here in terms of what APRA may or may not do. So they're looking at what's happening at the moment in terms of lending practices and the bank's lending standards. And they're not actually concerned because they've seen no meaningful deterioration in banks' lending standards. So in relation to what the media tends to call risky loans, they're not looking at this and saying there are any great risky lending standards that are being utilised at the moment. So they're actually very robust. And this makes them feel a lot more comfortable than they would otherwise be. And they're probably going to sit on their hands, I would think, certainly for the best part of this year, and perhaps next also. I don't see that there's really this pressure for them to act unless you're really referring to house prices by themselves. And I'll come back to that a little bit later on. But if we look at it fundamentally, interest-only loans are running currently around 19% of new lending. And that's pretty much the average over the last 2 years, which is low compared to prior times in our history. Another measure that they use is loan-to-income ratio. If that's higher than 6 times, it may be considered a risk. And again, at the moment, those loans are running at around 7% of total new lending. So there's not a lot there to make them have to move. And unlike what's happened in New Zealand, where the government has really made the central bank try and also contend with rising house prices, the RBA is not doing that. And they're saying, well, if lending practices do become risky, we can always get APRA to come in with their Macro-Prudential controls to try and cool things down. So the other important issue is to look at, if you look at the stats on new lending altogether, most of the increase has been driven by first home buyers and now upgraders, not investors. There's only been a slight uptick in the last month or two of investor participation. So that's the other thing that would need to happen, because otherwise, you know, we could be sitting here and speaking about a regulator or a bank coming out to try and cool the rise of the price of, say, something like Bitcoin, because it's just getting too expensive. You know, it's an equation that really doesn't make a lot of fundamental sense. So we've got to make sure that the right regulators are looking after the things that they actually need to look after. So if we look at all of this in, if you like, in tandem, and then sort of say, well, you know, where am I likely to buy? So if I'm going to buy somewhere to live, it's not driven by an investment decision, it's by a lifestyle and perhaps employment situation. So if you're having to buy in Sydney, yes, certainly I can see how people are really struggling with where prices are going. And affordability at some point in time must, I think, come into play and create some more evening out of the playing field, because prices can't rise at this sort of rate sustainably into the long-term future. But if you're looking at it from an investment viewpoint, of course, you could look at research for other markets and perhaps choose to enter a market where the entry price is far lower than the price in Sydney. Importantly, though, let's bring that into context. With today's data, Sydney house prices are only 2.6% higher than their all-time high, which was achieved in July 2017. So in reality, Sydney home prices have only really increased around 0.61% per annum for those 4 years. Now, that's a pretty small increase, I'm sure you'll agree. And then if we look at wages growth, it's been pretty shallow also, but it's been about 2% per year. And then if you put on top of that at the moment, people are really, borrowers are really making use of these really low 2, 3, 4 and 5 year fixed rates that are being offered by the banks, because the RBA is allowing them to do so through their fiscal and monetary policy settings. So if we look at that, new borrowers are now taking about 26% of lending on fixed rate loans. That's actually halved the cost of borrowing. So if you put all those things together, I can actually see property prices continuing to move up, because if you look at it rationally, that makes sense. So don't lose sight of this. Don't lose sight of the fact that this actually can continue. And it's I know it's pretty disheartening for people who are looking to buy, especially into the Sydney market at the moment, because it is really difficult. This is being exacerbated by a low level of stock. So, you know, there's not enough stock available from the sell side. Buyers are being thwarted left, right, centre, and it is really frustrating. And we understand that. But you've got to look at the fundamentals, not just from your own viewpoint, but from what's actually happening in the marketplace, and what I actually think will continue to happen in the marketplace, because you've got to then be able to make some informed choices as to what you want to do. So, you know, if you have to buy a house, different story. If you're looking to invest, you've got quite a lot of choices, but you need to get someone to do the research for you so that you make sure that you can actually make the most of this market, because I think it is one of those opportunities over the next 2 to 3 years that we may not see all that often in terms of actual price growth that is sustainable for that time. So then, coming back to the original question, let's think that through. If 26% of new loans are going on at 2 and 3 year fixed rates at the moment, they're going to run off in probably 2023-24, at which point in time I would suggest that fixed rates have moved up to some extent, and variable rates along with that. as we see, increase in 10-year bond yields and then increases in economic growth in the US, Australia, around the world. So I think the RBA has got plenty of opportunity to sit there and keep those short-term, the cash rate and the 3-year bond rate at the point where they are now, to stimulate the economy, to stimulate employment, which will then hopefully in their minds stimulate wages growth, which could potentially bring inflation back in within their 2 to 3% target range on a sustainable basis. So the bottom line to this question is, no, I don't think APRA will come in and use their macro-prudential measures at the moment, because there's no need for that to happen. And I can't see the banks actually allowing lending practices to become too risky, as the media says, because they're not doing it now, and they are actually getting pretty good credit growth and they're writing high quality loans. So why should that change? Some pretty fundamental reasons, I think, to basically say, look, the shop's in pretty good order. And I think this will continue. But I do understand, people's frustration. I was talking to one of our clients, who's in Hong Kong, and he's been looking to buy into the Sydney market for a number of years. We had a discussion about this, 4 or 5 years ago, and he wanted to buy something in Sydney's eastern suburbs. And the kind of home he wanted to buy then was going to cost him $5 to $6 million. So he's now looking at this and going, gosh, look at what's happening, look at this increase. And he's saying to me, all I can hope for is that, growth explodes and inflation explodes and rates go through the roof and there's a massive downturn in the Australian property markets. He then said, I don't think that will happen though. So, if you look at it in this light, I think it's pretty important to recognise that everything is going really well. You can't get too, I guess, distressed by what's happening in the marketplace, because we've been saying this for pretty much a year now. It's amazing what COVID has done and how the regulators have coped with it, governments have coped with it, we as individuals have coped with it. And, we've had great opportunities to enter the market, and we still have great opportunities to enter the market if we're property investors. As I said, if we're home buyers, well, it's slightly different, and we have to look at, I guess, what we can afford. So in that respect, the momentum of money hasn't changed that much. It's still pretty difficult to get outsized loans from banks, and they do assess serviceability very stringently. So those lending standards are going to be protected for the long term. I look forward to the rest of your questions, and we'll try and cover things off next week. But we'll also go through this in a lot more detail when we do our quarterly update, our next one being on the 15th of April, and then also on the 28th of April. So if you're interested in going into some of the more detailed data and a bit more granularity around all of these issues, please attend, and I'm sure we'll be able to answer some further questions for you. Once again, I'm Andrew Unterweger from Wise Guru. All the very best to Aussie expats all around the world.